What's up, everyone? It's Scotty with MoneyVest. So in this video, I wanted to summarize everything that Jerome Powell and the Fed said in under 5 to 6 minutes. We'll try my best to go through all my notes here and break down exactly what Jerome Powell said. The meeting just ended less than 10 minutes ago, so I want to get this video out as quickly as possible for all of you, so it's super helpful. Make sure that you drop a like, subscribe to the channel if you're joining us for the first time. Link to our Discord and Patreon is going to be down below. It's first week of the month, and I did introduce brand new spreadsheets that everyone can access and view our data-driven, very important analysis on volatility, intrinsic values, members-only private videos, trading view charts. Everything's going to be available with a link down below. Would love to have you on board. So let's get started. The first thing they did was obviously keep rates steady. So there was no change in the federal funds rate, staying steady at 5.25% and 5.5%. And continuing on their rolling over of the balance sheet with $35 billion worth of MBS, mortgage-backed securities, and just about $60 billion of treasury bonds, totaling just under $100 billion worth of balance sheet roll-off between treasury securities and mortgage-backed securities. They also mentioned that since they started, there's been over 525 basis points worth of rate increases and over $1 trillion of treasuries have been rolled over, and yet the economy continues to be super strong and the labor market continues to be very tight. And in other words, Jerome Powell did sound like saying that why is the economy so strong, and they're just as surprised as we are that the GDP continues to grow strongly at 4.9% in the third quarter. We got those numbers earlier. Consumer spending is still up, although there's some arguments to be made that that's on the back of credit cards and debt levels that are going up. Housing activity is lower because mortgage rates are sitting at their highest levels in over 10 to 15 years at over 8% on a 30-year fixed rate mortgage right now. He also did mention the average job gains, just over 266,000 and 3.8% unemployment rate, just goes to show that, once again, the labor market is extremely strong, and there is some possibility, right, for a potential soft landing. That is still their objective. Their goal is to bring inflation down while also keeping the unemployment and the economy very good. Although they did mention that the likelihood of that happening is low, and I'll get to that later in the video. He also mentioned that job vacancies have been moderating. Inflation is still above their target, and he says, and I quote, "The process of getting inflation sustainably down to 2% has a long way to go. We're not at sufficiently restrictive levels yet." And as soon as he said that we're not at sufficiently restrictive levels yet, the markets did drop, but then of course they recovered later. And he said that financial conditions have tightened, but they're not tight enough. And yields are pushing higher, so treasuries have been pushing up, of course, increasing the borrowing cost, and of course, tightening the conditions overall in the US even further, and they welcome that, but that's still not restrictive enough because it is very volatile and it changes month over month. So we want something that's more persistently tight. And when asked about rate cuts, they mentioned, or Jerome Powell said, that we don't even know whether we're going to hike interest rates in December, let alone rate cuts, right? Rate cuts are not even a question right now. They're way into the future, most likely towards the back half of 2024. So in about 12 months, 16 months from now is when the question is going to be more valid. But right now, there is not any discussion related to rate cuts. So that's certainly out of the question yet. But of course, in 2024, they've priced in 2 rate cuts still in their summary of economic projections, and they are going to be releasing the new SEP in December as well. Now, this is a very resilient economy, and that's both good and bad. And that's good because it reiterates, like I said, the soft landing assumption, because look, at the end of the day, the Federal Reserve's goal really is to bring inflation down. And they have made some progress on that because core PCE, which is really what the Federal Reserve's tracking, in the third quarter down 60 basis points, is what Jerome Powell said when asked about whether this elevated level of over 3%, how high does it need to be in order for the Federal Reserve to double down and start increasing rates even further. So they mentioned that, there's some lag effects with the interest rate hikes, and nobody knows how long those lag effects take. Some people say 6 months, some people say 12, some people say 18 months. So the main goal right now for the Federal Reserve is to go as slowly as possible and to do these pauses so that they can better evaluate how the economy is responding to the higher interest rates for longer, right? So they don't want to raise interest rates anymore, but they want to keep them where they are and better understand how the economy may respond in the future. Is the labor market weakening? Is there softening in the jobs market, right? Is the economy starting to show signs of weakness or falling through the cracks or showing signs of some contraction? That would suggest that, okay, that is what's needed in order for inflation to come down, and that's really going to be a result of higher interest rates. But none of that is being seen right now, which again is both a good thing and a bad thing. Good thing because it reiterates that soft landing assumption, but bad because it's most likely going to hinder inflation's ability to come down, is what Jerome Powell said. Because in the past, we've seen that these two things have had to weaken in order for inflation to come down. Soft landing scenarios very rarely play out eventually in the future. So he said, and I quote, "We at the Fed and even himself, Jerome Powell, believes that it's likely to be true that softening in the labor market and below trend growth in the GDP is needed to see inflation come down." And he said, again, we have seen some progress. Core PCE is down, but wages are not driving inflation right now, and we are now balanced in terms of risk of doing too much versus doing too little. So we now have, again, just a couple months of data coming in. We've got the unemployment report coming out on Friday. Inflation numbers are going to be coming out very soon. And then December, we've got another set of unemployment and inflation data until the next Fed meeting. And that's also going to be the summary of economic projections. And again, the market's expectations are going to be a pause for December as well. But then when asked for whether 2023, if there's no rate hike in December, can we assume that we have reached that terminal rate, or can we assume that we have reached that peak? To that, he did once again mention that they don't know. They're going to be very, very data driven, and they're looking at a multitude of different data sets to better understand and go over exactly what the next step is going to be from a Federal Reserve standpoint. So that's a overall summary, kind of highlighting some key points from Jerome Powell's speech in the Fed meeting. The markets are still very, very elevated and pushing higher. Of course, we've got the nasdaq up a little bit over close to 1.6%, with the S&P 500 also up over 1%. A lot of individual stocks also rallying over 2 to 3%. So hope you guys enjoyed this video, found it helpful. If you did, make sure you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below, and we'd love to have you on board. So always happy investing. I'll see you all in the next video.